What's up, Outliers? Happy Wednesday. Another day, another dollar. Another day that the government shut down. Plenty of fun going on there, and the market literally couldn't possibly care less. We just notched all-time highs again today. SPX is at like 67.50. So market up until this point really very content with forecasting right through this shutdown. We did a little bit of a deeper dive not that long ago on shutdowns, so I don't want to spend too much time on that point. But there actually was an article that I saw today from, I think it was from Morgan Stanley, that discusses government shutdowns. So I thought we could take a look at that together, seeing as we are in the midst of another one. And in case you don't remember, some of the high-level wave tops from the last time we chatted about these were the fact that it's effectively a coin flip what S&P does over the duration of the shutdown. Typically on the day that the shutdown, well, I guess shutdown ends is a weird way to say it. We could just frame it as when it opens. When the government isn't shut down and does open, that's almost always an up day. The overall movement during a shutdown is not that profound in either direction. There's a slight tendency for upward drift. The longest shutdown that we had was like 35 days, if I'm not mistaken, and that was in 2018, if I'm not mistaken. The average is about 5 days. We are now on days coming up on 7, I think. What was yesterday, the 6th? I don't even know what the day of the week is. What is the day of the week? The 8th. Yeah, Wednesday. So, oh shit, it's Wednesday. Yeah, so it is 7 days. For whatever reason, your boy really thought it was Tuesday. That puts us above average, but still a ways to go. One of the interesting things, and this is not going to get political, I don't care. One of the interesting things I do see right now is still a lot of finger pointing. Both sides, meaning Democrat and Republicans, are essentially calling it the other party shutdown. So Democrats are saying it's a Republican shutdown. Republicans are saying it's a Democrat shutdown. Just real difficult to have a healthy negotiation when that's the position that both sides have. The reason why I mention that is it would not surprise me if this is not a super brief shutdown. The other commonality is Trump was the president during the last shutdown, and that was, well, the longest shutdown, which was 35 days. Wouldn't surprise me if this follows a similar playbook where this might be a little bit on the extended side. The trick to that, we start to lose fidelity on a lot of important metrics that we talk about. Things like jobless claims, things like PPI, CPI, things that we're actually using to gauge inflation and make decisions about inflation and management techniques, specifically from folks like the Fed. That's actually kind of sort of problematic. If we take a look at the FOMC plots and see what the recent probabilities are, take a quick look. About the same. There is a little bit of a drop from a week ago. It was all good just a week ago till it wasn't. That's a Black Thought quote, in case you didn't know, from a freestyle he did that was like 15 minutes long. The dude's a genius. 99.4% probability of a 25 bips cut down to 94.7. That is not an insignificant delta. That is a meaningful change. There is a very reasonable probability that the Fed might choose to become a little more cautious with respect to cuts if they're not seeing the information that they need in order to make decisions. I also have talked about the politicization of the Fed. Again, not saying good, bad, indifferent, one way or the other. It is what it is. It is pretty political at this point, and we know, objectively speaking, that Trump and Powell do not get along. That would naturally follow the thought pattern. It's very likely Trump wants a cut. We know that. It's very likely that Powell wouldn't necessarily jump to get that outcome until he's firmly comfortable with making the decision. This becomes a viable catalyst to say, I'm not so sure if we need to cut rates, not necessarily in the upcoming meeting. I think the upcoming meeting is almost a foregone conclusion, not quite, but close. But the December meeting starts to become a little bit more interesting, especially once we see whatever happens post-October. The meeting minutes came out. That looked to be pretty clear, the language used and the general tilt that the committee had. Not a ton of surprise with what was in there, and we're still looking at a overall probability of 2 cuts into the end of the year. So we have the next meeting on the 29th, and then after that will be 10 December. We'll see. I think what I'm paying most close attention to during the shutdown, as I've discussed, in terms of like a broad profit mechanism built around this, has way more to do with volatility and when it reopens. So today, for example, was a great day to trade intraday vol. A lot of my volatility trading has come in time a lot. I used to have a much broader book of trades that were based around index vol that were going out like 2 days, 3 days, 5 days, 7 days, 10 days, kind of a bunch of different expirations. But with the way volatility behaves and just how fat risk premiums still tend to be in the near term, that's where I've spent a lot more of my time, effort, energy focusing those kind of strategies. Today is a great day for stuff like that. Again, never know when you get punched in the face and ran over, but these specific kind of days tend to provide a pretty solid opportunity. Taking a look really quick across the market, there's 2 things to highlight. Utilities continuing their broad trend, and healthcare still now consolidating sideways. It's had that big surge like 3-4 days. And then from there, it's just been rotating sideways. This had everything to do with Pfizer being able to work out that drug deal, unintended, with Trump to avoid tariffs by lowering their own prices. That information is being digested. So far, I've not actually seen as strong of a reversion catalyst in the broad index. But as I recently spoke about with the pro members, this is exactly the thing I was talking about trading, this right here. When Pfizer had those massive 2 days followed by a 3rd day, we had talked about different ways to trade this kind of movement. And the exact framing that I provided is that a lot of this seems like strong near-term news catalyst that tends to distort prices, leading to reversion of some degree, kind of like a rubber band that's being stretched. The interesting thing with the overall catalyst with Pfizer is it's not like their entire landscape is now easy. And I talked about this. They still don't really have a lot of friends in most political places right now that are in decision-making, things like Department of Health and whatnot. So that headwind is not abated. They also made a concession to avoid tariffs. The concession was, we'll lower our own prices. That still includes lowering prices. That still hits margins. This, to me, seemed like a primary trade for some level of reversion. That doesn't mean in my mind that it goes back down to the 24 handle. I have absolutely no idea where it's going to go. But the very first play that I had in mind is that as soon as this reversion started on the 6th, take it to the downside. There's a bunch of different ways to do it. This super short-term trade idea. overall expectation is that it will normalize, begin to grab a bid and consolidate sideways at whatever the terminal value is perceived based on this new information. But the broader landscape for Pfizer has not changed. It just is now able to take the lesser of evils and rather than being tariffed, cut its own prices. So that'll still net them out slightly positive ahead, which again, that would lead me to expect it wouldn't necessarily revert back to pre that catalyst levels. But I also don't think that they send this thing into the stratosphere. Because remember, this thing is getting smashed over the last 3 years. It was up at like 54, almost 55, and it's literally in half over the last 3 years. Pfizer has gotten absolutely crushed. The stock itself, it does seem to be consolidating. It's been consolidating in these low 20 handle for a while. We'll see where it goes. Doesn't really matter to me. Near term is always just playing simple ideas like that. And I really don't have any broader thematic plays on in something like Pfizer because I just don't really care. The other thing I want to talk about really quick is AMD. This is a really powerful move. This move is also highly indicative of how profound this entire AI transformation is going to be. There is no shortage of conversation out there saying things like, oh, it's a bubble, it's an AI bubble, everything's going to crash. Who knows? It might. The reality, though, is there are a lot of people putting trillions of dollars behind this structure and technology. I do not think they're that far off base. That does not mean it doesn't crash. Crashes can happen not always due to purely logical reasons. It could just be from positioning. Somebody has to take some sort of risk in, causes some sort of algo sell-off. Like all that stuff can happen. Longer term, though, I still hold very confidently that any of these names that are deeply involved in the AI sphere, if we go 3-5 years out, are going to be worth more than they are now. The technology itself is incredible. This kind of move highlights that. AMD is a massive company, and it not only had this gap up from 168 to almost 230, but now it's closed at 230 on an insanely strong day. And this has a lot to do, well, pretty much primarily predicated on the news with OpenAI. Anything that OpenAI is touching is experiencing this kind of stuff. That also gives you a pretty good idea on where the incumbent is, OpenAI. There's a lot of other platforms. There are a lot of other platforms out there that are looking to compete. Claude, Gemini, Grok, there's tons of them. Meta has their own. It's super clear, though, that OpenAI is a massive player. I don't think that's some sort of hot take. You kind of have to pick some of your horses, though, which I think is interesting, especially because you can't get direct exposure to OpenAI. Well, you can, but you just can't do it through like an open market. You can still, there's still positioning that's done through crowdsource investing, through direct investing, angel investing. All that stuff was available multiple times over. The way that this move continues is what's most interesting to me at this point. Do we see AMD at these quite literal transformational levels and hold these? Or does it start to trickle back down again as that news and that catalyst abates? That is the near-term target. Either, as always, entirely probable, but right now it does look like it's favored to the upside, especially as the broader market is continuing to roll. Rising tide lifts all boats. tech is still one of the top performing sectors and will likely continue to be so, as well as financials. In case you're not paying attention, financials have very quietly been crushing it. We're coming into another earnings season now. We actually spent a while framing out different earnings plays. We talked about building logical approaches to earnings yesterday. The way that you trade earnings is really nuanced. I find the more that I do this stuff and the more that I spend time talking with traders, the more I gain a really clear understanding of what's going on for a lot of people, which is the profound gap between what people think they're doing and what they need to do in order to make a successful go at trading long term. I talked about this with the pro community a bit to try and reorient the way that people think about this stuff. The Cliff Notes version for that conversation is trading provides immediate access to markets and the ability to make money. That access confuses a lot of people. There's literally no cap on how much money you can make trading. No cap whatsoever. You can have 6-figure days as a regular retail trader. 7-figure days, I mean, you have to be, I wouldn't even consider that like a regular retail trader. 7-figure days is massive, but definitely 6-figure days. That comes at a cost. A lot of people are very interested in that outcome, but they're not interested in the work that goes into it. If you like fighting, for example, you like the UFC, the people that make it and become champions are typically people that have an obsessive level of involvement in the sport. And even though they might be the favorite, they might be the incumbent, most of them still absolutely work their asses off to be there. It's no different in anything else. We've been reading Ewan's unreleased book that he shared, and one of the things that he mentioned in there that I'm now starting to talk more readily about, because I think it's such a powerful note, is trading is one of the only career fields where people feel like it's completely logical to behave 100% unprofessionally that would never be accepted anywhere else. Recent example, we were talking about trading earnings and somebody had asked a question about, hey, what do you do you have a plan on when you exit your position, after the open based on different conditions? And my answer is, of course. However, a follow-on comment was that it feels like for that person that there's a bit of guessing going on, which is completely fair. For a lot of people, that's exactly what it will feel like if the prep work isn't complete. That prep work is what ultimately leads to the performance. Most people are really ready to jump in and think that somehow the conditions are going to be different for them. And most of those people are just going to lose their money, which is super unfortunate. I genuinely hate to see that. I would never wish for anybody to not be successful at this. Even if they have a terrible approach, I still want that person that's YOLOing to hit. And it's because I understand the context that most people are trying to trade, which is to literally change their life. Difficult to do. The last thing I'll say on that general thread is if you choose to go down the path and focus on the trading side of stuff, the beautiful part is that there really is nothing that is that crazy about it. It really isn't astrophysics that you have to learn. You're not creating new elements. You're literally just interacting with a very tricky system, but it has repeatable patterns and it provides a lot of potential for returns, but they don't just materialize out of thin air. So the decision for the person that feels like, or for anybody that feels like what they're doing is like guesswork or just kind of hoping that something works out, that doesn't need to be the case, and that really isn't a viable approach long term. Okay, let's now talk a little bit about GME WS. I think it's /WS in here. Yeah. GMEWS. On the day the warrants came out, they opened at like what, 2.25. They rallied up to 6 very briefly on really, really light volume, like 185,000 warrants, and really just kind of trickled down over most of the rest of the day. The warrant trading window is super, super interesting so far. It's not all that surprising to see these priced where they are. Let's take a look at what a comparison can look like. If we look at GME outright, we go out to October of 26 and we go to the 32s. Those are trading for $3 and change. So when I had a bunch of people emailing me asking what price that I thought those warrants were going to trade, it's effectively something around this was my best guess. And it's a little further off than I expected, not going to lie, but not super, super far off. The warrants themselves are still going to really trade in I think a pretty compressed range, at least for a while. I'll show you. Until there's something that really causes a stronger breakout. So if you take a look at GME WS, and then if you take a look at GME, the overall volume today was 7.5 million, which sounds like a ton, especially just in the warrants. But this is also when they first opened, when they first hit the market, and GameStop volume today was 7.1 million. So it's trading about commensurate with the underlying, which that sounds about right. Again, given the fact that this is like the first day that the warrants are actually trading, which I think is solid. The important thing to remember for everybody that is trading these warrants is that they are going to decay. And you have to keep that in mind. If you're curious what the decay will look like, again, you can go out to October, take a look at the 32s, and see what the decay looks like for those options. Your decay in the warrants will look similar to that. I mention this because I've seen a ton of people talking about buying a ton of warrants, which is cool, right? Like literally everybody here knows I'm the biggest proponent of do whatever is right for you. You should do whatever that is. But it is important for everybody to know that you are holding a decaying asset. The warrant themselves are going to decay. And it's because they're a contract that's tied to a period in time. The good part is because the period in time is a year out, essentially, the decay will not be that significant. Also because they're slightly out of the money, which kind of helps things a little bit too. But just make sure you have that baked into your plan, because one of the things and one of the reasons why I've gotten so involved with GameStop and I continue to provide just general information and coverage on it is because I know there's a lot of people that are fascinated by it, rightfully so. You know, I'm right there with you on that end. But I really, again, just traders in general, I just hate to see traders losing money unnecessarily. So that doesn't mean do anything in particular. It just means know that as time passes, this is going to decay. Now, that decay can be offset based on price movement. If you start to see GameStop, the underlying going up, you will see the value of the warrants going up. It's just like a call option. As the probability of that thing falling in the money goes up, they're going to have more value. Then as they fall, hopefully in the money, they will then have intrinsic value that will not decay. because that represents moneyness. That intrinsic value is effectively anything above 32. As soon as they hit 32, they have moneyness and they have intrinsic value. It's very likely in the next few days that you'll see the activity in the warrants be pretty elevated. That would be my guess. Again, just because they're new. They just opened for trading and it's in something that's super, super, super volatile, like GameStop, which is going to provide some fireworks, I think. That's also why you saw the move that it had today. That's a big move in terms of a range that it had today. But the volume itself will probably normalize. It right now, even on the open for the day, it doesn't even pace the 5-day average volume for GameStop. It's sub that. So I still consider the overall volume today to be relatively light, all things considered. A big part of that is just because it's not super liquid yet. As more and more trading occurs in there, liquidity will deepen out. You can see that also reflected in the various options chains that include the warrants as part of a deliverable. So let's take a look at the 21 noves and let's just compare the bid-ask spreads. These are 7 cents wide at 25. These are 70 cents wide at the 25. So even the options chains that include the warrant as a deliverable are super liquid. So when I was managing my covered strangle in GameStop, I was moving some of my options. I have right now standard covered strangle, which is long stock, short cash secured puts and short calls at a ratio to the long shares. And I purposely did not go. I had the warrants because they were automatically adjusted for the short calls that I had, but then I purposely moved them out of those warrants into as part of the deliverable into just the standard chain. The standard chain itself still has pretty solid vol as compared to the chain with warrants. But like the difference is not that crazy, right? So if we look at term vol with warrants and without warrants, term vol is like 57.88%. With warrants, it's 57.54. It's about the same. So there's not like some sort of massive amount of excess vol baked into the options that have the warrant as part of the deliverable. And it's just because, again, the warrants are super far out of the money. It's nothing exciting. If those warrants start getting closer and closer to at the money and becoming more valuable, it's very likely that you'll see a premium in the volatility in the chains that include those warrants, which is pretty fun to monitor, but we're a little bit of ways away from that, I think, right now. Okay, so let's see what you guys have. Now's a perfect time. If you have questions or anything that you want to take a look at, let's do that. Let me get to the chat, say hello to everybody. What is up? Lauren says, I thought I was going to have to wait till Saturday to ask about the warrants. No way, Jose. Definitely wanted to talk about them today, specifically because they started trading today. There's a lot of interesting movement going on with them for sure. What's up, ZX Borg, Kirk, and Reese? Good to see everybody. Agent says warrant volume is greater than stock volume. Yeah, it was by what, like half a million shares or something today? Yeah, definitely, for sure. Lauren says, I got my warrants in my account, but I couldn't buy any. He said I have to purchase them during market hours, and it was. Well, I also think, if I'm not mistaken, you're not using like a prime broker. So that's kind of part of the cost that you incur when you use smaller brokers like that. Agent says, is there much of an IV difference between warrants and an option? It's a good question. It's really hard to say right now, to be honest, because GMEWS, like, we can infer what those look like, but there's no options on GMEWS. So there's really nothing that we could look at to actively deduce what the implied volatility is. And it's because the implied volatility is derived from options chains. So you could estimate what the implied volatility would be, but you also need a little bit more trading history in order to do that, which is actually a model that I already built for other names that I'm going to track GameStop's, at least what I call the interpolated implied volatility, since it has no options chain. My instinct is that it will have higher vol than the underlying, at least in the beginning. Then my instinct is that after the next week or so, I wouldn't expect the vol in there to be super high. The reason for that is right now, when the thing first starts trading, volatility typically explodes. And it's because there's a lot of people that are first getting entry to it. From there, then it's a slightly different story. As again, if it remains as far out of the money as it is, it's a pretty low probability right now. What is the probability for those? So right now for the 32s, it is a 25.5% probability of being in the money and a 56% probability of a touch. So it's still pretty low probabilities as it sits right now. Dan says, so as price goes up, say $1, shouldn't the warrant go up a similar amount? So at $30, we could see $9 warrants are in that ballpark. No, that's not how it works. The way to think about the warrants is that they are going to behave very similar to these options right here. So what that means is the assumption, Dan, that you're making there is that it would move dollar for dollar, which it will not. So the GME warrant ticker essentially is a strike. It's essentially a 32 call. Essentially, not quite, but essentially. So right now, it's all extrinsic value. There's no intrinsic value. As GameStop goes up by $1, you do not get $1 here. This does not work that way, because that would be the equivalent of being long shares. That would be a delta of 1. The delta on these right now is 45-ish, 0.448. What that means, if GameStop goes up by $1, these will increase by 0.45, 45 cents. These will also have a measure of gamma. The reason why they will have a measure of gamma is because the closer this gets to being at the money, the higher the probability that it's going to be in the money. So what that means is the subsequent move. So this is, call it step 1, based on current pricing. Step 2 would be GameStop goes up another $1, and this option now would go up 50 cents. And then step 3, GameStop goes up another $1. This goes up now 57 cents. So you can see it's nonlinear. The other thing to keep in mind is, as this is happening, there are other forces at play. Those other forces include theta decay, which we talked about, and then changes in implied volatility. The implied volatility component of something like the GameStop warrants is going to be a black box. And it's because we can't imply it from anything because there is no options chain. but we can still derive it once we have a 20-day trading history. We can interpolate it. So we won't really know what IV is in it just yet. A good proxy, again, is this. Use the expiration that has the warrants. I just realized that I think I used the wrong, because they have the warrants in this one. Same. So the expiration with the warrants right now is at like 51.55%. Here it's at like 48.66%. So we can see that there's definitely a little bit of elevated vol here. And the implied volatility for the 32s right now is 55%. So right about there. This is how they'll behave. So as they get closer to being in the money, they're going to be worth more. As they fall further out of the money, they're going to be worth less. As they go further out of the money, they're going to lose gamma, meaning the overall changes, the rate of change of delta will also contract. So right now, they're effectively behaving like these 32 calls that are out in 16 October, something like that. I'm lost in the chat. Okay. Art says, could you explain why some options get warrants? Definitely. The way that this worked is all of the existing options chains that existed before the warrants, they were adjusted to include the warrants. All of these were adjusted. They existed before the warrants were offered. So it means that as the holders of record came through, all of these existing options chains were then adjusted. However, after that date, the warrants aren't offered into perpetuity. So that's why they opened up new options chains that now do not include these. What you will see is as we get closer and closer in time, these will fall off and go away. The new weeklies that are going to pop up aren't going to have them. And it's because they're not part of the deliverable there. Those will go away. So it's just an adjustment to pre and post warrant offering. That's all. Kirk says, how did you play the downside short-term move in Intel? I used a couple different things. I had synthetic shorts and then out of the money kickers. Most of it was pretty near term in time. Dan says, I deposited more to buy more warrants on Schwab, but they wouldn't let me buy them until the cash settles. Yep, that's normal. That's completely standard. That's not anybody doing anything weird. I know that the GameStop community is like super sensitive to fuckery, which again, I don't blame you guys, but yeah, that's completely normal. You have to wait until the cash settles, which is standard fare. Agent says, I think I'd rather have a warrant than the option. It's limited with more tracking than the option. Yeah, I would say whatever asset makes the most sense for you, use whatever that is. Again, the most important thing to pay attention to with the warrants is that they're effectively going to behave like these 32s. So it means that you're going to have something with low gamma and you're going to have something that isn't going to move a whole lot. If you're looking to play big moves in convexity in something like GameStop, you probably wouldn't want to use these because they're so far out in time and because they're priced the way that they are, they're not going to compound a ton unless you get a massive move. And it's, again, even in that scenario, you still would make more money trading a nearer term at the money option that's going to have more gamma. I would not restrict myself to any one individual thing. The way that I think about trading, and I share this with people broadly, is I don't consider myself like an options trader. I just consider myself a trader, and it's for stuff like this. There's times where the warrants will make sense to trade. I traded the warrants today in and out because I got some of them. And then I built the position on just because I fully expected the first part of the day to be wild. And I thought that the risk to the downside was relatively controlled. Again, just using the value. And again, I was a little bit off, but using the value of these calls to try to estimate where it might go to the downside, because it still will have some level of value because of the duration of the contract. So yeah, pretty normal. Josue says warrants have been delivered, and it seems the naked short theory didn't work. What was the theory for the shorts on this? I'm actually super curious. Jeffrey says, why wouldn't I just sell all the warrants and buy GME stock with the money? You could do that. It's completely viable. It's a different play. Just like, let's say, for example, right now, somebody has 10 warrants. If you sell your 10 warrants, which I don't know what they're trading for right now, let's just call it like I'm just going to call it like 250. So if you sell your 10 warrants and you get your 250, you can get one share, right? So you buy to open one share. Yet those warrants gave you access. You had 10 warrants in this scenario. So it's going to behave like a larger position. So this is the standard game of leverage. That's why. So the people that choose to maintain the warrant position, completely logical, makes sense. It's due to leverage. And then the people that choose to just take the cash while they might perceive it at a high level and then buy the shares, that's also cool too. That's a longer term position. So it really just depends on the position that you want to maintain. That's all. Dan says, I suppose I was trying to oversimplify the Black-Scholes formula. Oh, I see. Yeah. The way to think about, well, BSM with something like this is that's really what we would use to figure out what's the implied volatility. But yeah, because there's no options chains in the warrant contract itself, there isn't anything to imply. So then you kind of have to interpolate it yourself. Yeah. Obamacare 907 says they were talking about exercising these warrants and making a squeeze out of it, right? Oh, Tenny Man says no. That would be a wild choice. I'm very glad that whatever that was opted out of, because that just doesn't make sense. Agent says the interesting thing were the emails that maybe ComputerShare or GME sent them. Registration numbers were there. Yeah. Because, yeah. Tenny says, as every OPEX falls off, the adjusted options in the money will begin requiring warrants to be delivered with the shares. Huh? As every OPEX falls off, the adjusted options in the money will begin requiring warrants to be delivered with shares. The theory is that more options in the chain than there were warrants. That doesn't matter, unfortunately. We took a look at this together because we actually did this exact math prior. And the total number of options outstanding pre-warrants was like 750,000 calls. So it's not even close in terms of a sufficient number of warrants to cover those. There's a way to circumnavigate that, which is just to provide the cash value of the warrant. You don't have to provide the warrant itself. It's at least for the option side, because there is a cap, but there absolutely is a potential to have more than the cap. In those instances, those people would just be paid out the current value of the warrant. So yeah, that wouldn't make sense. Kirk says probably that GME goes meme stock level again, like 100 plus. Well, the thing is that And it's one of the reasons why I think that GameStop is definitely more volatile with the warrants in the near term, because the warrants themselves, they do add another layer of convexity. It does not surprise me that there would be some level of plumbing issues supporting supply and demand. So that itself can absolutely cause pretty profound movement. And I mean, we saw that, right? Again, like let's remember what happened today in the warrants. The warrants today made a absolutely massive move, right? They opened at 380, like 398, 381. And the high for this candle was 599. So not quite 100%, like 80. Well, no, I guess technically they opened at 225. Yeah, my bad. That was a complete lie. I forgot that was the second candle because they were super not traded. The first candle. It wasn't until the second candle that any liquidity entered. So they started at 2.25 and they hit almost 6. So a massive, like that is in effect a squeeze. Like that's essentially what that is. It probably got heavily traded by the algos, which will always happen with shorter term surges like this. We looked at an example recently in another stock. I forgot what it was, but trading it to the downside that got kicked off over the course of a couple minutes. The good part is that it's really liquid. That's awesome to see. The fact that this thing is a penny wide bid ask is nuts. It's super cool. I know a lot of people have a lot of issues with the market and, you know, transparency and stuff. And I would consider all those viable but separate issues, because the fact that this thing is trading that narrow is insanely cool. Just launched today. So that part's pretty sick. But yeah, I think to summarize all that, in the near term, I think the excitement around the warrants will exist for a bit, especially as people are trying to play the ebb and flow of the value. It's likely that there'll remain elevated volatility, at least in the near term, until that stuff settles out. And then they're very likely to just trade super similarly to what you see in the 32 long calls out in October of next year. So while they remain further out of the money, lower probability, probably not super exciting. But I do think that as GameStop starts to approximate to those falling in the money, that is where things start to get more exciting, because not only do you get a dollar for dollar increase once you're in the money with your intrinsic value, but the dynamic of the warrants will change a little bit. So that is when it really becomes interesting, is when GameStop is hovering around those levels. While GameStop is chilling at like the mid 20s, even sub 30, a little bit less fireworky, and GameStop does have a little bit of ways to go before it starts cruising back up to those levels. So interesting. All right, gang. Hope that's useful, but I am out of here. Be an outlier. See you guys later.